The global economy is built on one undeniable truth: every nation is in debt. The United States, for example, now owes over $38 trillion, an all-time high. The European Union carries around $14 trillion. Japan's national debt is nearly $9 trillion. And even nations with substantial wealth, like Saudi Arabia, and economic powerhouses such as Germany and China, owe staggering amounts of money. But here's the real question: if all these countries owe so much, who exactly are they owing it to? It's easy to assume that there's a faceless creditor somewhere, a single entity that holds the world's financial strings. But the reality is far more complex. Debt is not just a burden. It's the foundation of the modern financial world. Every war, every economic boom, every crash, and every crisis, these events are all sitting on top of an invisible scaffolding made of debt. It's the framework that supports the global economy. And if you follow the trail of creditors long enough, you'll discover something unsettling. The world doesn't owe money to anyone in particular. It owes money to itself. You might be wondering how this works. How is it possible for the world to owe money to itself? To understand this, let's go back in time, centuries before credit cards or digital transfers, and look at the origin of national debt. In 1694, England was in the midst of war with France. The king, William of Orange, had run out of gold and was desperate for funds. He turned to merchants for help, offering them a deal. In exchange for financing the war, he would promise future interest payments backed by taxes. To manage this arrangement, the Bank of England was born. For the first time in history, the government could borrow money it didn't yet have. And the merchants had something invaluable: a government bond. These bonds could be traded, bought, or sold, creating a new form of wealth and investment. This was revolutionary. What followed was a system that spread across the world. France adopted it. The Netherlands refined it. And the United States, newly independent and in the midst of fighting for its freedom, used it to finance the revolution. Soon, national debt became not a sign of failure, but a sign of credibility. Nations could borrow money to fund wars, build infrastructure, and expand territory without the need for gold or natural resources. Debt had now become a tool of governance. By the 19th century, debt was no longer just a means of survival, it was a symbol of power. Empires that once relied on conquest and gold now issued bonds to raise money, and the bonds were backed by the ability of those governments to pay interest. The balance sheet had replaced the battlefield. Debt was no longer a weight to be borne. It became a strategy to expand influence. Fast forward to today, and debt is no longer a tool. It's a commodity. It's the driving force behind the world's economy. The United States, with its $38 trillion debt, stands as the largest debtor nation. Japan, with its $9 trillion debt, follows closely. And the debt isn't just an issue for the wealthiest nations, it's a global phenomenon. Total global debt has now surpassed $315 trillion, nearly 3 times the size of the global economy. It's not just a number on a screen, it's the weight that nations, banks, corporations, and citizens are carrying. But who holds the other end of the rope? Who actually owns this debt? Let's look at the United States, which offers an interesting example. Of the $38 trillion it owes, about half is publicly held. This means that the U.S. government owes investors, not other branches of government. Most of these investors are American institutions, banks, pension funds, mutual funds, and insurance companies. But here's where it gets interesting: about 1/3 of the debt, roughly $9 trillion, is owed to foreign entities. Japan is the top holder, with around $1 trillion, followed by China at roughly $800 billion. Other countries, such as the UK, Luxembourg, and Belgium, also hold portions of the U.S. debt. But when people say the U.S. owes China, it's not the full picture. While it's true that China holds a portion of the U.S. debt, it's only about 2% of the total. The reality is that most of America's debt is owed to Americans. The U.S. government issues bonds to raise money. These bonds are bought by banks, funds, and the Federal Reserve. The Federal Reserve often buys them back, creating new dollars in the process. Those dollars are then used to pay interest on the bonds, and the cycle repeats itself. It's a circular system, where the debtor and the creditor are often the same entity. But this isn't just an American issue. It's a global cycle. Japan lends to the U.S. through bonds. The U.S. lends to Europe through the International Monetary Fund. Europe lends to developing nations through the World Bank. And those developing nations often hold Western debt, creating a circle of credit that spans continents. It's like a game of musical chairs, where everyone is holding someone else's debt, but no one ever seems to stand up. The markets play a crucial role in this system. Behind every government bond is a web of institutions, hedge funds, sovereign wealth funds, pension funds, and central banks managing trillions of dollars in assets. These are the institutions that decide which nations can borrow at low rates and which ones will pay a premium for survival. When these institutions lose confidence in a nation's ability to repay, the effects are felt globally. Currencies collapse, governments fall, and economies can spiral out of control. And then there's the role of central banks. These institutions don't just manage debt, they create it. When the U.S. Federal Reserve or the European Central Bank buys government bonds, they effectively create new money. This process turns government debt into a valuable asset that's used as collateral by investors and institutions. Every dollar, euro, and pound in circulation has an invisible IOU attached to it. There is no such thing as debt-free money. The system has worked for decades, primarily because people believe in it. As long as investors believe that governments will continue to pay interest on their debt, the system keeps turning. But what happens when that faith falters? We've seen this before. Greece faced a debt crisis in 2010. Bondholders panicked, interest rates spiked, and the European Central Bank and IMF stepped in. But their solution came at a heavy price: tax hikes, austerity, and unemployment. In Argentina and Sri Lanka, repeated defaults have turned debt into a national curse. When the system breaks, the creditors, those anonymous bondholders, the IMF, and rating agencies become all too visible. But here's the catch. Even after a collapse, the system doesn't end. Old debts are restructured, new loans are issued, and the debt machine starts up again. This is because, in the modern financial system, debt isn't meant to be repaid. It's meant to be rolled over. Governments don't aim to clear their debt. They aim to keep it manageable and sustainable, ensuring the system keeps running. Debt has become like a subscription service. Instead of repaying the principal, governments issue new bonds to cover the old ones. Interest becomes the real product, an ongoing rent paid for the stability of the global system. The entire global economy depends on that rent. Like a shark that must keep swimming to stay alive, the financial system needs governments to continuously issue more debt. Imagine if the U.S. suddenly decided to pay off all its debt. The global financial system would collapse. The dollar would lose its stability, and markets would spiral into chaos. The very thing that makes the economy function would disappear. Instead, governments continue to issue debt, not recklessly, but with precision. Debt has become the heartbeat of the global economy. It pulses through every pension, mortgage, and financial transaction on Earth. Politicians who talk about balancing the budget or paying off the national debt are selling an illusion. The truth is, the goal isn't to eliminate debt, it's to keep it sustainable and manageable. But there's a problem. The benefits of debt are not shared equally. While debt flows upwards to the wealthy institutions and investors that hold it, the interest payments are extracted from taxpayers and workers. This is why global inequality and global indebtedness rise hand in hand. The system rewards those who own debt and punishes those who are stuck paying it. The line between debtor and creditor is becoming increasingly blurred. The modern financial system has turned debt itself into money. Governments issue it. Banks multiply it. Investors trade it. And citizens depend on it. The world is locked in a system where debt is the central engine of everything. But if that system ever falters, if trust in debt breaks, the entire financial world could collapse. So, when you ask, who holds the credit? The answer isn't as simple as pointing to one institution or country. It's everyone. From governments to citizens, from banks to pension funds, we are all connected in this global web of debt. And if that web ever unravels, we'll all feel the consequences.